Welcome back to Overtime. This morning's PCE report showed no signs of inflation slowing down, rising 2.8% on a yearly basis. It was a bit hotter than expected. If inflation remains sticky this summer, could Biden's chances of winning re-election be in danger? Well, joining us now is Dan Clifton from Strategas. Dan, it's great to have you on. And just in terms of that question,
yep.
Is this how voters are going to be voting this year, with their pocketbooks based on inflation?
Yeah, there's obviously extraneous variables this election cycle that you haven't seen in the past, like Trump's legal issues or Biden's age. But the economic issues still are the dominant factor for voters, particularly in the 7 swing states that are going to decide this election. We try and keep it pretty simple at Strategas by just looking at kind of what's worked historically. And the misery index, inflation plus unemployment, has predicted 15 of the past 16 presidential elections. It's very simple, Morgan. If misery is higher year over year by the election, the incumbent party has generally lost. And if misery is lower by the election, the incumbent has generally won. And so we know what that number's got to be. It's got to be about 7.3% by election day for Biden to win. We're actually below that right now, which is good for the president. We're at about 7.05. But it shows you that he doesn't have much wiggle room. And the greatest threat to his presidency is a sustained surge in inflation this summer, one that is probably not expected by the consensus. But as long as inflation keeps surprising on the upside, it will pose a risk to his reelection.
OK, so then how does PCE that we saw today factor into that? How does the GDP reading yesterday that stock sold off on factor into that? I mean, the word stagflation is now starting to be tossed about. I realize one report a trend does not make, at least not yet. But how real is this risk when you have a Fed that is saying it's data dependent and a market that is predicting it's not going to cut as soon as the summer anymore?
Absolutely. Look, the data's changed. And I would say that January was a data point. February was a line connecting those data points. And the March data was a trend. So the trend has clearly moved. I think that's why it's more of a risk today. But the president also has tools, Morgan. If you start to see that gasoline prices go up, they could release oil out of strategic petroleum reserve and try and get those prices down. That's what they did in 2022 into the midterm election. And some of the president's advisors were publicly talking about that last week, right? So for every action, there will be a reaction. But clearly, the data has moved away from where the Fed wanted to be, and it's going to make it harder to cut rates. That does not mean that the Fed doesn't have other tools available to them. We expect that the Federal Reserve is going to start cutting the size of its quantitative tightening as early as next week at that meeting, where you'll see them reduce their balance sheet by half of what they've been doing to about $30 billion a month. So there are definitely tools that can play with. And from the president's perspective, he's got tools. This is why he's talking about student loan cuts. He's got a lot of infrastructure money starting to come into effect that you'll see it later this year. So it's not a static environment, but clearly the inflation numbers have moved in the wrong direction.
Back to the election, the mechanics of that. Is the economy more of a motivator or a demotivator? So are independents going to come out and vote for change if things are bad, right? Or is it more the base either does or doesn't turn out, based on what the economy is telling them?
Yeah, so what we do is we use historical standards on the economy. So we got a new data point today, which is after tax, after inflation income. It is a major, robust indicator of predicting the exact vote that the president gets in re-election. And so that number, when it came out today, because it continues to show that inflation is rising faster than total personal income, comes out to about 48% of the vote for the president, right? So if you use that historical standard, use the inflation unemployment standard that we just talked about, you're basically trending at close to a 50-50 race right now. And these races are being decided by very, very thin margins. You're talking about 50 to 75,000 voters, and there's going to be a mix of issues there.
So
the
what, if
economy is going to be one of them.
Yeah, what, if anything, then, is the impact of this bifurcation between the working class and the very well-off? Does that potentially cause some variance in what the numbers have historically told you, say, over the past 40 years?
No doubt about it. And things are changing here. So what you see is that former President Trump is doing well in Nevada, a state he's never won. He's doing much better with low-income workers who are very much worried about inflation. But if you look at Trump's numbers in Pennsylvania primary this week, he's not doing so well with higher income workers, or what I would say traditional establishment Republicans, who are less affected by inflation and more going to vote on his values itself. So this is a real game-changing environment that we're in right now, where you're actually seeing voters switch allegiance through parties. And inflation is a big part of that. Growth's a big part of that. Taxes will eventually be a big part of it. But clearly, the divergence between lower and higher income workers is having an effect on where voter preferences are going to be.